Hey, everybody. Welcome to the morning market briefing, Wednesday, March 16th, 2022. Hope you're doing well out there. Big day. Fed decision looming. Obviously, Russia-Ukraine conflict. I don't know. Kind of seems muddier by the day. Markets are certainly responding relatively favorable over the last 2 days. Yesterday, market up quite a bit. Today, futures up quite powerfully. So things looking green, at least at the moment, but I expect some volatility throughout the day. Ben, update us kind of on the state of the war, where we are. We're going to hear from Biden later today. Zelensky's going to address Congress. But what all is going on?
Yeah, I think everyone who's anyone is talking today. You got Zelensky talking, you got Biden talking, you got Fed Chair Jay Powell talking, you get the Bank of England talking tomorrow, you have the Germans talking, you have NATO, everyone's just going. I'm not sure anyone's really listening. So the state of the negotiations right now, you got Russia saying a neutral Ukraine with its own army could be a compromise. So they're looking at kind of a model similar to Sweden and Austria. And I think that's definitely a step in the right direction. That's an improvement from yesterday when Vladimir Putin said that the Ukrainians aren't being serious about compromise. Zelensky said negotiations are difficult, but there is room for compromise. Talks will resume today. So it does seem like we're getting somewhere on negotiations. At least they're talking, and there's some talk about wanting to compromise. I don't know if this is just talk for talk's sake or if it's actually something more meaningful, but that's where we stand on that. From the Western point of view, Zelensky is going to be addressing Congress today at Congress's request. Remember that he also addressed a few senators a couple weekends ago, and he also addressed UK's Parliament, and he addressed Canada's Parliament yesterday. So he's kind of doing the road show right now, trying to drum up some support and continue to get funding and support from NATO allies. President Biden is going to be speaking on the Ukraine situation later today. He's going to be talking about the new $1 billion in military aid that's going to go to Ukraine. There have been some reports out that the administration is looking at giving the Ukrainians drones that'll be able to target a lot of the Russian tanks. So that is something to watch. I think ultimately that will not happen because that would be a clear escalation, in my opinion, that they don't want to go. If they're not going to provide jets, I don't think they'll provide drones, but that would be my opinion. As far as the war goes, it's difficult to know really what's going on. We do know that Kiev continues to get bombed, but then Ukrainians continue to come with these counteroffensives. I don't trust anything the Russians put out, and I know the Ukrainians are really trying to have this national pride and spirit and demonstrate that they're really fighting back strongly. So it's difficult to know what's actually going on. With respect to sanctions, I did attend a small gathering down at Georgia Tech yesterday with about 20 others. Dennis Lockhart, the former Fed president, was there, and he was asked a question on sanctions and does sanctions work? And he said that up until a couple of years ago, the conventional wisdom was that sanctions do not work. However, he said that seemed to change with Iran when they seemed to get some progress as a result of sanctions on Iran. And he said that you really need a young population and a large population to put pressure on the government, and that's how you get that done. So he says that there has been some change in that thinking, but up until a few years ago, the impression was that sanctions do not work because there's always ways around it. So that's what I have to say as an update on the war. Not a whole lot changed. It seems like we might be getting, at least people are talking about compromise. So I guess that's good news.
Yeah, it's kind of they're talking about compromise. Kind of how the Fed was not even thinking about raising rates a couple years back. So it is progress, I suppose. I agree. I mean, it's very hard to tell what's actually happening, what's actually going on. Obviously, it's not a pretty situation there, but it's hard to really discern how the actual battlefield is playing out in a lot of ways. China, we do have a bit of an update on. They're trying to spur economic growth. Vice Premier came out and said that the government should actively introduce policies that benefit markets. Something that I think everyone would generally agree with, regardless of the nation. But I feel like we've heard this story before from China. Ben, what's different this time, and do you think they'll actually make progress on that front?
I think they were talking about doing things like this, but now they're actually pretty aggressively doing it. They gave the wink, wink, nod, nod to a lot of insurance companies, wealth management firms, businesses with a lot of assets. And they said, look, what's the direct quote? They said, long-term institutional investors are welcome to increase shareholdings in Chinese companies, basically saying, please buy our stocks. They say that continuing economic development is the first priority of the Chinese Communist Party, which I think is a positive considering everything they were talking about last year in terms of Xi Jinping's framework for how he wanted to run things, which seemed to degrade the economy in terms of the priority list. It also kind of takes Taiwan a little bit off the table if the economy is the number one priority. They talk about reducing regulation, saying, hey, we're going to try to get everything done on this regulation of these internet companies as soon as possible. We recognize it's an issue. They say that they're going to grow new loans, quote, proactively. They're going to introduce a plan to prevent and resolve risks around real estate developers like that one that had the big issue last year. And then they are also going to talk to their banking and insurance regulators are going to guide wealth management companies to, quote, stabilize capital markets and boost stock investment. So they're really trying to get people to invest, and they're trying to get these economies and these markets up. So it's a very proactive, I would argue, authoritarian approach to getting people to invest. But that's how they're structured.
There we go. Tons of economic data coming, and we're going to let Tom kind of wrap up the show here in a moment with plenty of analysis on the Fed side. But we do have retail sales just came in. Not a great number. The expectation was for a 0.4% increase excluding food and gas. We actually were negative, but with that, we got a pretty massive revision to the January retail sales data. Previously was reported at 3.8%. They revised it upwards to 4.9%. Ben, what else are you keeping an eye on as it relates to economic data outside of, obviously, Fed decision?
Yeah, it's really interesting. The gasoline factored big time into that number because the headline numbers actually came in broadly in line, but you strip out gas and all of a sudden you're talking massive declines. And this is what gasoline prices do. Gas prices go up and you don't have as much money to spend on other retail goods. And so January was a lot better than previously thought. And then February, by contrast, was in terms of absolute value, it was about what people had expected. But in terms of a change from January, it's significantly worse. So we're going to continue to watch out for that. We do have an American Express investor today. I was thinking some slides would drop before the call, but they haven't dropped yet. So I'll continue to keep an eye out for that. Tonight, we have Lennar, the big home builder. They report earnings. Dollar General will report earnings tomorrow morning, and then FedEx comes out tomorrow evening, and they might have some issues with especially in Europe. They have a large European business in TNT that they acquired a few years ago. And then, of course, central banks. We have the Bank of England tomorrow evening. We have the Bank of Japan Friday morning. But it's really all comes down to what happens at 2:00 today, because this is going to be the first rate hike since December 18, and it's going to be the first rate hike, first time we've actually lifted off from zero since December 2015. Last time it took us 27 months to get 6 rate hikes. Now the market implies 6 rate hikes in the next 9 months, a third of the time. So it looks slated to be a lot faster rise. And Tom, what are your thoughts on that?
Yeah, so I think this is going to be far more in line with the early 2000s, where they raised, I think, 17 times in a row. Basically launching into the what would eventually be the global financial crisis, where we began zero interest rate policy, where we've been for 8 of the last 12 years, at least that I've been trading bonds. And so this is our second attempt to reach an exit velocity away from zero interest rate policy. I feel very confident that we're going to get one hike today. If we get two, I think it's going to be a massive surprise, and we're going to see maximum volatility in the market. If you look at the implied futures right now, we've got about a 13% chance of a double hike, so pretty unlikely. Though, if you look at the way the futures are structured, we're probably going to get a double hike either at the next meeting or the following one in June. So we'll see how that turns out. But my expectation again is that Jay Powell has basically stuck to his guns. I think he was very slow to act. He probably should have tapered last year and lifted off somewhere in the November range. But I think in the interest of stability, he did not. And so here we are. And in the interest in stability, he's not going to do a double hike this time. He's just going to do one, but set the expectation that going forward, they're going to be pretty flexible on how they're going to raise rates. And my expectation is we'll get at least one double hike in the first half of this year, whether it be in May or in June. He's got a tightrope to walk, though, because you basically got a couple different scenarios, right? We've got a lot of downside risk to growth in the Ukraine situation with the Russian sanctions. You got possible contagion. You've got counterparty risk. All of these things could really hurt growth globally, as well in the U.S. as in the U.S., which could lead to a situation where they're not going to be hiking as much, or it's unnecessary to do so. On the other hand, you've got inflation that has, we've just seen the two largest prints in the last 40 years back to back on CPI and PPI. Even though, sort of the house view is that was peak inflation, that it's probably going to have a glide path back towards a normal range towards the back half of the year. It's not impossible for it to continue going, especially, with everything that's going on. China having a little bit of COVID concerns, that could definitely ramp inflation back up should they go a little crazy and do a full lockdown. So they really have to walk this tightrope, and I think the best way to do that for them is just to be as cautious as possible. I mean, we talked about the last time we raised rates, that was December of 2018, and that's pretty much universally considered to be a policy mistake, that they raised too many times, and that caused a slowdown. The yield curve inverted. We got a little wonky on bonds for a while there, and then eventually, when the yield curve inverts, we typically have 12 to 18 months later a recession. Even though it was caused by COVID-19, that did come to fruition, and so they don't really want to get in a situation where they're inverting the yield curve, and that could happen very quickly. Should we continue to see strong demand for long bonds as they raise rapidly? You can see the front end of the curve come up very quickly, and we're very flat on the curve right now, and so that could happen faster than you think. So there's just a lot of moving parts. I'm really interested to see what we're going to get in terms of verbiage on the quantitative tightening, which is essentially the opposite of taper. And the expectation laid out by Jay Powell so far is that they're not going to be net sellers of bonds. You got to remember, they just finished buying bonds as recently as a couple of weeks ago. They were still buying treasuries, still buying mortgage backs. So they're not going to turn around and raise rates and then start selling them. But we are going to definitely have some roll off. The bonds that they've been purchasing and putting on the balance sheet for the last couple of years need to start rolling off. And we've still got bonds from the first QE on that balance sheet that was still elevated before we even started COVID-19 and the zero interest rate policy of the last 3 years. So there's a lot of work to be done. There's a lot they can do. The question is it going to be effective? And I can turn it back over to Ben. He went to a presentation, shout out to Akash Prasad, the godfather of our modern intern program at Georgia Tech, hosted a talk with Dennis Lockhart, the former Atlanta Fed president, who gave some commentary last night. And, Ben and I put together some questions to potentially ask with Akash.
Yeah, so we sat in with Dennis Lockhart yesterday, former Atlanta Fed president, and it wasn't inspiring in terms of how much the Fed knows. I mean, they have a bunch of economists on staff. They have a lot of data, but he used on multiple occasions the following phrase, and I wrote it down because I wanted to make sure I was accurate with it. He said, "It's like you're feeling around in the dark. You push the envelope until the envelope pushes back. It's always an exercise in feeling your way along in terms of, how do you treat interest rate hikes? How do you manage all these things?" And he says, sometimes what is the signal that you get? Well, you could get a call from Jamie Dimon. You could have some market volatility and actually use Jamie Dimon's name. He says that He doesn't have 100% confidence that the Fed can control inflation. He has a lot of sympathy for the dilemma at the Fed right now, and he's not convinced the Fed will succeed. The best bet the Fed can hope for, he says, is a combination of a natural decline in inflation over the course of the year, and the Fed gets lucky as they hit these rate hikes, inflation comes down, Fed can claim victory. But he says that that's where they're hoping that they have some success. He says that Fed's kind of given up on using velocity of money. He says that apart from rate hikes controlling inflation, they don't have great empirical data on a lot of this. They don't have great empirical data on quantitative easing, good or bad. They don't have a great way to handle deflation, but they did say that raising interest rates could handle inflation because you can basically raise interest rates as high as you want and then until it breaks. And as Tom mentioned, that could flatten the yield curve, which is something that we've already seen, which might not be the desired intent from the Federal Reserve. But I thought it was a very interesting, sobering, humble look at Fed policy, but not one that necessarily inspires a lot of confidence. So Jay Powell is going to have to inspire a lot of confidence because the market's now up about 3 or 4% in the last 2 days. And he's going to have a bar to jump over. And that press conference will start at 2:30 today.
Yeah, the alarming part, I think, is the best case scenario is the Fed gets lucky. My hope would be the best case scenario would be the Fed makes informed decisions based on good data and makes the right decisions along the way, as opposed to, inflation rectifies itself and the Fed gets lucky by accidentally raising rates correctly. I mean, that's pretty terrifying. You hope that maybe Dennis Lockhart is just an idiot and that everybody who's still currently in the Fed is a lot smarter than he is. But that kind of transparency is a little bit sketchy. It's not ideal.
Yeah, you almost hope that it's a bit of false humility or even just sympathizing with the situation. Hey, I've been there. It's really tough. Let's not expect perfection. I don't know. I mean, yeah, I agree. It does not necessarily inspire confidence. Weird commentary. Ben, last thing, Starbucks CEO stepping down. One of your favorite people in the world, Howard Schultz, coming back as interim CEO. What are your thoughts?
Yeah, I'm not thrilled about it. I'm not a big Howard Schultz fan. He got rid of the Seattle Supersonics, and we haven't had a basketball team in Seattle for the last 15 years. We didn't have the Kevin Durant time. But he's going to take the helm at Starbucks, and I think that a CEO change may have been needed. And Andrew and I have talked a lot about this. Andrew's been following Starbucks very closely over the last couple of quarters, and we just continue to be we continue to note the Starbucks emphasis on China and the continued pointing to as China as a source of growth. And we have not seen the data that really supports that thesis. And I think that Ron Johnson, the current CEO, is paying for that with his job.
Yeah, I mean, it's telling that was announced this morning. Stock's up close to 5% in pre-market trading. I mean, you're exactly right. It's, things consistently go poorly in China as they report on that segment. And they consistently say, this is going exactly as we planned, ahead of schedule. And certainly the analyst community does not seem to think that's the case. And they seem, I don't know, it's interesting if you listen to their earnings call, for every bit of actual functional business feedback they offer, there are 2 pieces of general cultural commentary. It seems like they've taken their eye off the ball a bit, and China may just be one example of that. We'll wrap it up here. We'll be back tomorrow, and we'll talk to you guys then. It'll be a big call, I'm sure, as we react to the Fed announcement. But y'all have a great day.